All right, Carlos. Carlos has a question. He says he has 2 kids, 19 and 16, need to have insurance for them. Okay, if there is a policy that you can have 60 to 70% cash available, or is there a policy? For example, $10,000 in the first year and available 6 to 7K. If so, which one is it? Yes, there absolutely is policies that you can have 60 to 70% cash available. In fact, depending on what type of insurance you go with, you could have 90% cash available. You can get 92 or 93% cash available in the first year, within the first month. So there's a number of different policies out there. Now, when you're talking about kids, I would probably direct you to an IUL first. And there's a good reason for that. One, when we're talking, you can get the cash value available even in the first year in an IUL. It's not going to be 90%. It'll probably be closer to the 60 or 70% because of the surrender charges. But the growth potential that that policy has over the next 40 to 50 years is much higher than what you'll see in a whole life product. You can always try that policy out, see if we can get that growth that we're trying to. And if for some reason that doesn't work out while their cost of insurance is low, the cost of insurance doesn't start to really go up very much until 20 or 30 years down the road. And then even still, it's only still very small portions. It doesn't really get expensive in those policies until they get like 70 years old, 75 years old. So when we're talking about kids, you've got 50 years of ramp up where they don't cost hardly anything for the cost of insurance, and everything you put in above that has the opportunity to grow along with an index. So I'm glad you brought that question up because I happen to have something set up that I can show you guys, and it's a policy that I just set up on my kids. Now, this one is for a 13-year-old, but you're going to be able to see the growth potential that this particular product, in this case it's Allianz, you'll be able to see the growth potential over the next 50 years. And I got to tell you, it's kind of silly. But I'll quickly go through why that is. Okay, so this is Allianz Pro Plus Advantage. Now this is the actual illustration of the policy that I just got for my daughter. She's 13. And let me get over to that so I can scroll down and talk to you guys about it as I'm looking. Okay, so you can see we have an initial death benefit, $300,000. We've got this set up at age 12. I was able to get that in right before her last birthday. She just had a birthday. And we can see right here we have this illustration makes a couple of assumptions. Okay, it has 3 different amounts that it kind of displays to you some possibilities of potential growth depending on what the interest rate ends up averaging. Now these are all working with averages. Okay, if it gets an average of 6.73%, then we're looking at the results in the blue column. If it gets an average of 6%, we get the results in the silver column, and if it averages 4%, we get the results in the greenish column. Okay, so it's a $300,000 death benefit. At age 66, if we get a 6.73% interest rate, the death benefit in the policy is going to be close to $3 million. So it went up from $300,000 all the way up to $3 million. The planned premium, what I'm going to put into this policy, is $3,000 a year, just under $3,000 a year. This is maximum funded, okay? This is the most that they'll allow me to put into it, and so when I signed up for this policy, I designed it to where the base premium, the cost of the insurance, is very, very small. The minimum amount I could put into this policy if I needed to is probably a couple $100 a year. Okay, it's really not very much. Maybe $300 or $400 a year, if for some reason I needed to minimum fund it. But I'm planning on maximum funding it at close to $3,000 a year. Total planned premium paid over years 1 through 54. So I have this set up so that she's going to pay it all the way until a typical retirement age. That total is going to be almost $160,000. Okay? $3,000 a year, 54 years, $160,000. Now, tax-free access to cash value through policy loans. When she becomes retirement age, this, and you'll see the illustration when I scroll down, the potential for her to have this as a pension in retirement is $242,000 a year if we can get a 6.73% average, according to the indexes that we're tied to. That's a lot of money. I think she's going to be pretty happy if we get that kind of growth. Okay? The amount of money that she's going to be able to pull out of the policy if she lives to 120, which is when these policies mature, would be $13 million. So she would put in $159,000 in premiums, and over the course of retirement, which is like 50, 60 years, she'll be able to pull out $13 million. Now, if it's less, if for some reason it's 6%, now it drops down to $153,000 a year. That's still good. I'm not looking at that kind of pension in my retirement. So we're definitely going to be, she's going to be a happy camper if she even gets 6% average. And she'll be able to pull out $8 million over the course of her retirement years if she lives really, really, really long. Now, whatever she doesn't use ends up going to the beneficiaries. So her beneficiaries will still get a substantial death benefit. Now let me go down and show you how this works. In this case, we have specific index options, and this is why I really like Allianz for a growth product like this. They have some really good index options, and in this case, these are the two that I chose, the Bloomberg and the PIMCO. These are volatility indexes. There is no cap, which means if we get a really high interest return on any given year, the cap is not in effect. And not only that, but I get a 150% participation rate. So if we get a 10% return on the year, I get credited 15%, so 150% participation rate. I'll get credited 15%. And then on top of that, with these options, I get a 40% bonus on top of that. So from 15%, multiply that times 40%, that's another 6. Is that another 6%? Yeah, probably another 6%, right around there. So 21%. I would get 21% interest credit that year using these options. Okay. The potential is very, very high. The growth potential is very, very high depending on how the returns are. Now there's other index options, but I'm just going to go over these two because these are the ones that I chose. And the reason I chose them is the no cap, 150% participation rate. These are volatility indexes, which means they're actively managed to avoid the high highs of the stock market and the low lows. But over the last 10 years, this one has averaged almost 10%, 9.99% return. Over the last 15 years, it's averaged over 8%. That's before the 40% bonus. So pretty incredible. And if we can get that type of return moving forward, obviously there's no guarantees when it comes to the index options. There's no guarantees what the stock market's going to do in the future. But if we can get close to that, we're going to surpass that 6.73% average that this illustration is based on. And that means those numbers, the potential retirement numbers that she could get, are just, they're so silly. I don't even know what they would be. It would be really, really high. Okay, it would be really, really high. And there's one other aspect to these indexes that I like. You have the ability to lock the growth into it at any point throughout the year that the New York Stock Exchange is open. So, when might you do that? You might do that if, say, your policy anniversary is in April. Let's say your policy anniversary is in April. And March of this year rolls around, and your index is up 8%. And suddenly you hear about this Coronavirus. What's this coronavirus? What's that going to do to the stock market? Oh, it might not be very good. You know what? I better lock in this interest rate. You lock in the interest rate, you get the 8%. April rolls around, the stock market has tanked, you still get that 8% growth. And then when your policy renews right there, when your index option renews for the year, it doesn't renew at the locked rate. It renews at whatever the rate the market is. So it would start off right there at the bottom. So you just saved yourself from a 0% year. You got an 8% year because you had that ability to lock it. So I'm willing to spend a little bit of time managing this policy throughout the year. And by managing it, it just means I'm going to pay attention to what that index is doing. And I'm going to kind of pay attention to what the overall market is doing. Because if for some reason I want to lock it, I have that ability. Raphael, is it worth it to take an IUL for yourself, or is this an example better insuring for young children? I like them on both. It just depends on what your overall situation is and what you have secured in your wealth pyramid. So we have what I like to call a wealth pyramid. We want to have, each of us have a pyramid that our financial base is built on. And we want to make sure that the base of that pyramid is solid. Check out my videos on that, on the wealth pyramid. You want to make sure you cover that financial base. If you cover that financial base, now you've got that base of the pyramid and it can't wobble, right? That's why pyramids are strong, is because they have a very strong base. They can't just tip over. The problem is at the top of this pyramid is risky investments. Investing in investing in basically paper things that are not solid assets. I consider solid assets something like a home or real estate, something that's tangible where it can't just go to zero overnight. Something that would just be paper might be like a penny stock, something that all of your investment in it can completely disappear overnight. And people tend to invert that pyramid. So rather than covering their base and building a nice solid base, they build their wealth this way. Okay, they don't have a pension, they don't account for their Social Security, they don't have proper insurance, and what happens is that's very wobbly. It might start out okay, but it can tip over at any moment, and when it tips over, that's when people get themselves into financial trouble. So you want to make sure that you got that base covered. Now, when it comes to an IUL on yourself or an IUL on your kids, whether it's an IUL or whole life insurance, I like one or the other of that. Make sure you have yourself covered first. It doesn't matter if your kids are going to get better health insurance or life insurance rates and your overall growth might be better, because in all likelihood, you're going to pass away before they are. And the money that you put into life insurance on you can pass on to them tax-free as a death benefit. And if you pass away early, they're going to get that full death benefit. And when you turn that into a percentage of growth, that's going to outperform anything your kid's policy can do, unless your kid's policy is performed, for 30 or 40 years first, and you're still alive. But presumably, you get the policy on yourself, you're still getting good returns. If we can get a good policy design for you and you qualify for life insurance at a standard rate or better, we can get you good enough returns, and then you'll have the growth in that policy as well as that death benefit backing it up when you pass away. So I would definitely say cover yourself first, make sure you're covered, and then we can look at getting your kids covered. It also helps to understand that when it comes to insuring your kids, you're usually limited to half of whatever you're insured for. So insurance companies like to see parents covered, and when they come up with how much kids can get covered for, they will give a death benefit of half of what the parents get. So that's how that works, and hopefully that answered your question good enough. Carlos, can you have insurance for the kids paying $1,000 a month? Yes, you can. It'd be very hard, though. You have to have a lot of life insurance on the parent, because that would be a very, very large death benefit. So in this case, $300,000 is the death benefit for basically $500 a month. No, $250 a month on my girls. So if that was to be $1,000 a month, multiply it times 4, that'd be $1.2 million in insurance on the kids, which means since we're limited to half, That means I, as a parent, would have to have $2.4 million in insurance already. So if you already have a death benefit of $2.4 million, you could get $1,000 a month on your kid. And I've done that with folks. So it is definitely possible. But you got to make sure that you're covered first and you're covered for enough. This was a question asked and answered during one of our Wealth Care Wednesdays live streams. If you have any questions, leave them in the comments section below, or join us on one of our Wealth Care Wednesday live streams where you can ask the question and we'll answer it on the air live. I hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time. Now go maximize your cash flow.